Hello, and welcome back to another episode of me sticking my nose into these charts every single day until I discover a trade model that makes me millions and millions of dollars. And in today's session, I'm just going to be doing the same thing that I have been in previous episodes where I'm reviewing my observations on price and hypothetical trade scenarios that I would have taken. But today's price action was difficult for me to read because my trade model wasn't present at all. So post 9:30, it was very difficult. I did not have a clean read on the market, and this revealed a lot of character flaws about myself that I will discuss. But post 7 o'clock, at the very beginning of the New York morning session, I was actually able to find a pretty solid setup. And had I carried that throughout the entire session, I would have rode out the entire daily range. But that's in a perfect world, and I'm in my early phases of development. So in a real live trading environment, that probably wouldn't have happened. And to be honest, I think it would have came back, tagged my entry, and I would have stopped for break even on the remainder of the position. But I'll just go ahead and jump right into my first observation. But I'll show this first. So here's today, Monday, August 26th, 2024. My first setup that I got right was at 7:21 in the morning. So it was a pretty good session. Delivered 52 handles in my favor post 7 o'clock, which is pretty rare. Usually you don't get that amount of volatility early in the morning. So that was good. But post 9:30, things got really fuzzy for me. I did not have a clear read on the market at all. And that just made me frustrated. Revealed a huge character flaw, and I'm going to talk about that. But first, I'm going to go into this 721 setup. Let's look at the metrics. It took 26 minutes to deliver to my objective. It took 0 minutes to begin moving in my favor, and it moved against me 52 handles. Or moved in my favor 52 handles, moved against me 0 handles. So that was a hell of a setup, and that was at 7 in the morning. So you usually don't see setups this clean this early into the session. So I'm going to remove that. And here was my logic going into today. So immediately, zooming out to the higher time frame, this is what I saw. I see these clean, clear highs in the London session, right? So what's resting above those highs? Buy side liquidity. That area is smooth, so the market has the potential to draw up there and go attack all the buy stops resting above those smooth highs. And it's also a session high. It's session liquidity. So you outline your session liquidity. Above, it's right here. Below, it is down here. I think I marked out, was it these highs? Let's see, we're 7 o'clock. So below the marketplace, I marked out this liquidity and this liquidity, both relatively equal lows. All of these are relatively equal lows. So this is also an area price to potentially draw for. And if we're thinking in terms of the daily power of three, you simply want to see what side of the marketplace does it attack first, because that is usually the fake move. And in this case, we attack the sell side first. So what I was expecting to happen today was market run out these smooth, clean lows, and then I look for an indication in price that tells me it may have interest in drawing up to these highs. So that was what I was looking for in today's session. But post 9:30, I didn't get that at all, and that led to a lot of confusion and frustration. But starting at 7 a.m., at this point in time, that's 11. At this point in time, the draw on liquidity was very clear to me. The order flow was clearly bearish. That's how I was reading it. I saw this reaction off the new day opening gap. Order flow was clearly bearish. We have this order block right here. Come up, reject the order block. We have the sell side imbalance. This is a breakaway gap. If the market cannot even price to this sell side imbalance, that is indicative of weakness. So right away, I'm reading the order flow at post 7 a.m. and I'm seeing weakness. And once the market trades through the new day opening gap and gets beneath it, look how the bodies of the candles do not even close above the new day opening gap low. So that shows me that price is willing to move off of the new day opening gap low, mix that with the order flow being clearly bearish. And at this point, I had a clear draw on liquidity because everything in price was indicating that this thing was seeking sell side liquidity below the marketplace. So that was clear and obvious post 7 a.m. Go back down here, zoom back up in here. So I had those clean lows from the London session right here. And I also had a new week opening gap below the marketplace. So that is a very strong draw on liquidity. If I have relative equal lows and a new week opening gap, there's a very high chance that the market's going to draw down in there. So reading this bearish order flow, I'm thinking, yeah, okay, this is clear, it's easy. The market wants to go down here, disrupt these lows, and also into this new week opening gap. And reading this order flow, I see this clear, important sell side imbalance. It's just clear and obvious. What was I reading right here? Once the market reacted off the new day opening gap low like this, this was when I was anticipating a draw to these relative equal lows. So, and we can also see that we engineered more relative equal lows here that get ran. And when the market runs this minor pool of sell side liquidity, that's when we see a retracement back into this reclaimed fair value gap, and then we sell it from there. But if you look at this sell side imbalance, you can see that when we close back below it, look how the bodies respect the lower quadrant. So what does that tell me? That tells me this thing is weak and it wants to attack sell side resting below relative equal lows. So this is how I was reading price action here. And if we look at the last up close candle that trades into the new day opening gap, it also runs these relative equal highs right here. So we have minor buy side liquidity taps right here, trading into the new day opening gap high, a change in the state of delivery, a sell side imbalance. So everything right here is just pointing to lower prices. And look how the market reprices to the open price of that bearish order block and just rejects it to the tick. And we never even reference that point again. So this thing is clearly weak. And if I were to mark out this sell side imbalance, there isn't even a body close in it. The bodies don't even reach into it. We have one wick that trades through it, but it's simply because the algorithm is referencing the open price of this order block. So once I see this change in the state of delivery, I'm thinking, yeah, this thing wants lower prices. So this could be a hypothetical entry right here when we tap the open price of this order block and we close down below in the lower quadrant of this sell side imbalance. And if you notice, we also have a breaker right here, and we can see the breakers respected the entire time. And if I weren't able to get a short position on here, well, the market gives me another opportunity when we tap into this minor pool of sell side liquidity, retrace higher, and tap into that reclaimed fair value gap once again. And look how we barely trade into the lower quadrant, and then boom, this thing is heavy. So one thing that I've learned recently is that I have to be comfortable with retracements against my current narrative in play, and just read the intel that the market is giving me that confirms to me and reassures me that, yes, my narrative is still playing out. See, this is simply just a retracement to refer back to the sell side imbalance, and then we begin to roll over. So, yeah, we do have a change in the state of delivery here. The market is in a buy program, but look what happens when we react to this sell side imbalance. Barely wicks into the lower quadrant and then rolls over and attacks those relative equal lows. So when I see the market form this low right here and it comes just shy of this low and this low, what is that doing? In my eyes, that is priming that low, and that is engineering more sell side liquidity. So whenever I see this, whenever I see the market come trade down to a low just shy of it and then turn away, that is engineering more sell side liquidity, and I know that it's going to get ran over, absolutely ran over later on. Because what this does is, in retail's eyes, when it comes back down to these lows and then begins to turn away, they view this area as support because the market's coming down to it, turning it away again. And anybody who is long off of these London lows, because predominantly before 7 o'clock, most of the money is made on the long side of the market, right? So the market is punishing those longs, clearing them out, cleaning the tables. And when it turns away from this low down here, everybody who's long down here at the stop loss below these lows, they feel safe. They're like, oh, that was close. That was close, but it's turning away. But then it just taps to the sell side imbalance and then rolls right over top to them. Liquidity vacuum. It just straight up takes out everything. So that was this trade. Best case scenario, I would have gotten an entry here with the stop loss above maybe the mean threshold of the order block. So let's just say right here. Targeting, this is my first target, maybe second target down here. So it's good for 36 handles, 36, 37 handles. but it moved in my favor for a total of 55 before it eventually turned. So it was a 36 handle run in the 7 o'clock range, which is usually you don't really see that. And the risk is only risking, 3 handles? So, I mean, that's a really good setup. I would take that and be done for the day. I would just walk away. My lowest threshold entry, the easiest entry would be down here, which makes the trade a 6R. Risking 5 handles to make 34.25 at the final TP. So like partial 1, partial 2. And if I do a projection, let's see. And then my projection aligns with the PD arrays that I would be taking profits at, or the pools of liquidity. I would take my first partial here at a -1, -1.5, and my second at -2, -2.5. And trade would be done for the session. Boom. I'm done trading before 8 o'clock. That's awesome. Which would have been good on this day because post 9:30, my expectations and price did not fulfill themselves, and I was just confused and lost. Which is okay. That would just be a day where I sit sidelined. And that's something that I have to learn to be content with when I don't have a read on price, when my model is not present. Just sit sidelined. Don't do anything. Move sideline and say, okay, it's not here today. Something that I really, really have to learn is that not every day I am going to be taking a trade. That is 100% something that I struggle with when I was trading supply and demand, reading order flow. I would always impulsively force trades, jumping in and out of setups, even when my model was just not present. Very, very, very impulsive. I am extremely impulsive, and I will do things that I should never, ever, ever, ever do when my model is not present, and I know that I should not be trading. So that is a very bad habit that I have to overcome, that I have to tackle on early on in my development trading ICT now, or there's going to be a huge barrier to my success. And I will openly admit that I really struggle with that because that is something that I have to tackle. And if I can't tackle that, then honestly, I can't see success as a trader. And it showed itself again today without even taking any trades at all, not even in a demo environment. That weakness showed itself again today, that character flaw that I have, and I'm not even taking any trades, so that's not good. I have to jump on this right now, or this is going to be a huge barrier to my success, and it's just going to take way longer for me to see profitability. So I got to jump on this shit now. But anyways, huge character flaw that I have is I get frustrated. I won't lie. I get frustrated. I get mad. I get mad when things don't go my way. I get mad when I'm wrong. Those are two huge character flaws that I have to correct. And I have to tackle these right now, or they're going to be a huge barrier to my success. See, when I don't have a clean read on price action, I get frustrated. When price is not doing what I want it to do, I get frustrated. When I am wrong, I get frustrated. When I am in a trade positioned and it begins to retrace against me, it's not going as I want it, it's not playing out as I want it to, I get frustrated. So I know these things exist. I know what scenarios they occur in. Like, for example, if I were short off of this order block right here, if I got short off of this order block and we ran these relative equal lows, being retracing higher, I would see this and I would get pissed. I would be like, come on. And then I would just have straight negative thoughts. Oh, this is not going to play out. Oh, it's not going to play out. I'm going to stop out. Not going to go in my favor. Huge character flaws. Because I am assertive in my nature, and I don't like being wrong, and I don't like being proved wrong, and I like being right. That's just how I am. And so I carry that baggage into trading, and it does this, where I take a really impulsive setup. But first I need to go over the setup that I took at 9:30, hypothetically took at 9:30, based on the expectations that I had for this session. So I'm going to remove these. So prior to the 9:30 open, I mark out my session liquidity. Now I have these relative equal lows in place. And prior to 9:30 open, the market is ranging. It's trading sideways, right? So what do we do when the market is ranging? Well, you wait for one side of the marketplace to be taken because then it'll defer to the other side. And whatever side of the marketplace it goes to second, that's usually where we see the larger move. So 9:30 bell opens, and the first thing that we do is we trade lower and we disrupt all these relative equal lows underneath, all these relative equal lows and the sell side liquidity underneath them. But if you notice, the stop hunt is pretty shallow, not very significant. Now, if you compare that to this stop run on these relative equal highs that we disrupted, this is more significant and this does more damage. So I kind of beat myself up about that. Not really. I took the lesson I learned from it. I wasn't really hard on myself today. But I thought initially the market was trading lower to take out the sell side liquidity, which it did. It's just the extent of that stop run wasn't as significant as this one, because this one we see bodies closing above these relative equal highs. We see close above them and we see a lot of jaggedness. So comparing these two, compare this shallow run to this where we have actual closes above these relative equal highs, which one is doing more damage? This one. So the move at 9:30 initially trades higher, and that is the Judas swing. So I was a little disappointed that I couldn't read that, and I thought initially this was the Judas swing, the fake move, and this was probably going to be the real move, because I was looking for these equal lows to be disrupted and waiting for a signature in price that would suggest that we come trade higher and disrupt these equal lows. So that was what I was looking for. And tuning into ICT's live stream today, he was looking for the same thing. So I can't be mad about that. In hindsight, after watching him review today's session live, he was thinking the same thing that I had. So what does that say about me? I'm doing all the right things and I'm developing at a very rapid pace. If I can start to see the market the same way that my mentor does, that is great. That's phenomenal. And then he gave that whole lecture about how, when your model is not present in the market, when it's not present in price action, you have to sit still and you have to be content with that, which is something that I have to learn. Absolutely have to learn. So he was looking for these lows to get disrupted and then some signature in price that would indicate that we could trade higher and disrupt all this up here. But one thing that I have to learn, another crucial lesson, is that I force my will upon the market. So if I see an area of price that is smooth right here, I kind of think that it has to go there, and that is just an expectation that I set, and anything else that suggests otherwise I'm just completely blind to and I just completely ignore it. So not really reading price action objectively and only focusing on one side of the marketplace, because I think simply because it's smooth up here, the market has to go there, which is not the case. It doesn't have to go there this session. It doesn't even have to go there today. It could go there next week, So that is another barrier to my success that I have to overcome, is that I don't even know. Would you call that stubbornness? I'm not sure. But I outlined the same thing that ICT was looking for, so I can't be mad about that. So post 9:30, what I see is first presentation right here. This is that fair value gap highlighted in blue. The very first fair value gap post 9:30. It's this. So I highlight it. And I see kind of a breaker formation, right? I have a low, a high, a lower low, and a higher high. So I see this, and I see the first presentation. So I was anticipating that price would trade back down into first presentation, maybe tap the open price of this order block, which it does that exactly, and then trade higher and go disrupt the equal highs resting inside of the new day opening gap. So at the very minimum, I was expecting price to trade up into the new day opening gap for a 36 handle run. And that was what I was anticipating post 9:30. But clearly you can see that that didn't happen. And actually I was very, very confident that this was going to play out when I saw this and the market come back down, tap the order block, and we come trade higher. But we fall short of this high because we reject consequent encroachment of that wick to the tick. Let's see, 97.75. What's high on this? 97.5. So it missed it by one tick. So we missed consequent encroachment of that wick by one tick, and then the market reverses, rolls right over top of the opening of the first presentation and then fills in the opening range gap. So in this instance, what occurred here was the market traded higher, closed outside of the opening range gap, and then closed back below, forming this short-term low at consequent encroachment. So if this short-term low were to be taken out, then I would expect a sell scenario. Then I would look to be short. And that's what happened here. But at the moment, I wasn't reading that because I was anticipating a run to these relative equal highs. It just simply didn't play out. So maybe this would be a losing trade. Maybe this would be a losing day. But it's not smart to take a trade 2 minutes into the opening bell. It's just not smart. And I'll probably have to establish a rule for my process that states, not probably, I am going to have to establish a specific time of day that I'm trading a specific protocol within a time window where I go and hunt my setups. And this is not it. In the first half hour of market open, that's not it, really. I like waiting for post 10 a.m. And then something that ICT outlined in his stream today is when we see a opening range gap that is less than 30-40 handles, meaning there wasn't much action overnight, in the overnight session, there wasn't much of a difference between where we settled the previous day and where we opened, that is usually indicative of lower volatility and not so favorable market conditions. But when we have a larger opening range gap, that invites more volatility and larger fluctuations in price. But today we had this small gap. So immediately when I see a small opening range gap, the protocol is to wait post 10 a.m. I am not interested in anything until post 10 a.m. So I learned that today, which probably would have saved me a bit of a headache and just completely disregarded trading the 9:30 open. But I will note this. Let me look at ES. This is exactly what I want to see for a setup on ES. It's clear as day on ES, but it's not on NQ. So I may start watching both of the indices for this very reason. Look what we have on ES. We have all these clean relative equal highs. What do we do first at 9:30? We trade higher. We run the buy side liquidity resting above the London high. So what do we reach for first? Buy side liquidity. What is usually offered to the public first? The wrong side of the market. And that's exactly what we see here. 9:30 open, trades higher. We're breaking out from those London highs. Probably have a bunch of retail longs thinking, oh, we're breaking out. Let's get long. Let's get long. And they get trapped and raked across the coals, and this thing just sells off lower. But this is exactly what I want to see. I have my bearish breaker. You can see that we respect the bearish breaker for the most part. I have a run on buy side liquidity. I have an inverse fair value gap, and that inverse fair value gap is also first presentation. So that is key. That is very meaningful. I have two inverse fair value gaps. We don't even reprice to this one, so that indicates weakness. I have a sell side imbalance. We also trade to this sell side imbalance, right? First presentation, and look how we react to first presentation. We literally just wick into the lower quadrant. Don't come even close to consequent encroachment. So that is very clear, weak price action. And if I go to the 15-minute and I zoom out, what do we have? Well, we have what? A clear SMT divergence at that London high. So these were the smooth London highs that I wanted to see NQ, some signature in price to take NQ up and run the buy side liquidity above these highs. And look at the SMT divergence that we have at 9:30. Very clean, very clear at an element of time. So in hindsight, the short scenario was very clean, very clear, especially with this much of a SMT divergence. ES is trading all the way up to that London high. NQ is not, so I would not expect NQ to trade up to these London highs since ES took them, creating that Kraken correlation. And now I'd expect the market to turn lower. So one thing that I've learned is that SMT visible on a 15-minute time frame with an element of time is absolutely key. And this SMT occurs at 9:30, so that is crucial. It occurs at the element of time, the 9:30 equities open. But I was kind of thrown off because if we look at both sides of the range, there's an SMT at both sides of the range, right? But ES is also running the previous week high and NQ is not. So I think in this case I would place more emphasis on a bearish SMT rather than a bullish SMT because of all the liquidity that ES is tapping into, and NQ is just lagging, not even there. So that is weakness in my eyes. Kraken correlation, and that's where the market turns, and we get a large sell-off from there. Market never looks back from there. So in hindsight, yeah, this was a nice sell scenario. And if I look in hindsight, of course, what side of the marketplace does it take first? Well, if we compare this top run to this top run, the real damage is being done up here first. So the market is running buy-side liquidity first. It fails to trade it to the new day opening gap. What does that suggest? Weakness. What is this? A breaker. What is this? The most sensitive candle. What does price do? Trades up into it, rejects it. What is this? An order block. What does price do? Rejects it. What is this? A volume imbalance. What does price do? Rejects it. What is this? A volume imbalance. What does price do? Rejects it. What does it also do? Trades into the low, the opening range gap, rejects it. Trading into this volume imbalance and rejects it. So, in hindsight, yes, the sell scenario was very nice, although I don't think this was a setup that I would have taken. I don't know. Doesn't matter. The market provides unlimited opportunity, and if we look below the marketplace, what do we have? That's not right. One of these aren't supposed to be there. I'll have to fix that later. Oh, it's this one. I'll fix that right now. There we go. Nope, not that one. This one. There we go. Okay, what do we have below the marketplace? We have a new day opening gap inside of a new week opening gap. So this is going to act like a black hole and literally just suck price down there. And that's exactly what it does. So that could have been a draw on liquidity. Once we see this clear Kraken correlation at the London highs and the previous week high, and if we were looking for lower prices, we can see that this is a bearish breaker with an SMT divergence at the high, so that's smart money reversal. We fail to get to the new day opening gap, so that's an indication of weakness. We tap the opening range gap low, refer to this volume imbalance and this order block, and that is also rejecting all those PE arrays. So in hindsight, yeah, the sell scenario, pretty cool. But that's not what I was looking for. I was looking for higher prices. I was looking for something to reach up into the London highs on NQ. Now, if I was watching both indices, I would have seen ES take them and think, okay, ES took them, huge Kraken correlation. NQ's probably not going to reach them. But here's where I got frustrated with price action because I couldn't read it at all. And I just did something random and something that I would never take before. So I have a very clear idea of what my trade model is. I need to see a breaker formation, a change in the state of delivery, order block, inverse fair value gap, fair value gap. That's what I love to see, a run on liquidity as well. Here's what I see here. Here's the opening range low. We run the opening range low, so I'm thinking, oh, look, we have a stop run here, right? And then what do I see? Price trade higher. Crosses the open price of this series of consecutive down close candles, so I'm thinking change in the state of delivery. So once I see that, and I see these candles trade down into this volume imbalance in the bodies of the candles, don't even close below them, I'm thinking price is respecting this volume imbalance. I have a change in the state of delivery, and we can't trade down to consequent encroachment of this wick, so that's all indicative of strength. And this is a potential bullish breaker formation. And I took that as a hypothetical long. And at this point in time, I just absolutely wanted something to show me that price was going to go higher and go run those London highs. And I didn't have a clean read on price. It wasn't doing what I wanted it to do. So I was frustrated. You could say that I was bored. I was just looking for something to do. And so I did something completely random that is outside of my trade model, something that I would never ever consider taking if, the market was actually doing what I was wanting to do it and price action was clean and I had a good, clean, clear read on price action. This is just not something that I look for at all. At all. So when I didn't have a clean, clear read on the market, that made me frustrated, and that leads to something like this, where I just randomly take a setup that means absolutely nothing and is totally insignificant and not something that I look for at all. I mean, what is this? I see these 3 series of up close candles and I'm thinking, oh, it's reversing. Let me get long, right? And this was just them pulling the strings, manipulating longs into the market, which if I were trading in a live trading environment, I would have got manipulated into the market and then just absolutely rolled over top. So not something that I consider at all. And this would be my bullish breaker, and it never even closes over that. So there is no breaker formation that ever forms. I saw once we crossed over this, I literally thought, fuck it, let me try this. That was literally my thought process, and it was because I didn't have a clean read on price. I was just waiting for something that tells me the market's going to go the other way. Just waiting for it. I wanted it so bad, but it wasn't showing itself. So when my trade model is there, what do? Nothing. Literally, to do nothing. Sit sideline. Go do something else, right? So the market did the exact opposite of what I anticipated it to do. My trade model wasn't present based on what I was looking for. And that led to some frustration, some boredom, and then me trying something that I would never, ever, ever do. So this is an exact instance when I would step outside of my process and my procedures and my rules and just completely disregard my model and do something that I know that I can't do. So I'd have to screenshot this, record it, and make note of how I felt in that situation and study it and develop a potential coping mechanism for dealing with that. Because if I don't tackle this now, it's going to be an extreme barrier to my success in the future. So that is everything that I can cover for today. That's all I have to say. And I'm going to do the same exact thing tomorrow, of course. I'm going to do this every single day this week. And I'm going to try to get out a weekly review next weekend. I didn't do one this weekend because I was busy. Not like anybody was actually waiting for me to post that anyways. But a big focus of mine moving forward is going to be identifying my character flaws. What about me, what baggage do I carry into the market that makes me lash out in these kind of ways? What makes me feel frustration? What makes me feel anxiety? What makes me feel overconfident? What makes me feel fearful? Everything. Just identifying those triggers, identifying what I carry into the market outside of trading that is an influence to what I feel when I am trading and how that affects my thinking. And that is going to be a focus from now on. So I'm learning about myself and studying price action at the same time. And yeah, that's how the early stages of my development are going. And I know that I'm going to be a very successful trader, a damn good trader, an exceptionally good trader. And that is it for this video. Goodbye.